Hey guys, what's going on? How are we all? All right, thanks for joining me. Haven't done one of these in a while, so I thought it was only right that I actually did something. So let me know if you can hear me clearly. I know there's a couple of you in the chat already. How you doing, Kevin and Food Dweller? Welcome. I am good. Thanks for asking. How's everybody getting back to normal life, I suppose? And I've been really busy just trying to organize things. Stuart, evening. How are you, Abdul? How you doing, guys? All right. So as usual, I'll just use this opportunity to really kind of take some questions from you guys and have a conversation with you. We haven't done one of these in, I think, about 3 weeks or so. I'm going to be doing this one this evening, and I'm also going to be doing one on the 5th of September, which I believe is next Sunday. Is actually next Sunday with Gary Stevenson. So over the last couple of weeks, what I have done is on the Friday, I've actually posted episodes of my podcast. So when I have a guest on the podcast, what I tend to do is I'll record that episode via Zoom. So we have video and audio. Then I edit the audio for the podcast and discard the video. Because the conversations that I had with Gary were so important and they made me think a different way myself. I thought I have to put this out as a video on YouTube as well. It is quite lengthy because it is a podcast conversation. So I think, each of the conversations we had were about maybe 40, maybe 50 minutes long. So it is quite an undertaking for YouTube, I know, but the content is really valuable. The content is really important as well. So I thought I'd put that out. And here's a question for you guys. Do you want to see more of that stuff from the podcast? I was planning on putting the podcast out as a video audio piece, maybe a bit more produced, maybe not via Zoom, having a proper studio set up. But I decided against that purely because I've got to source a studio and then production, and that will take a team. And from a financial point of view, it wasn't viable at the time. So, and to be honest, it still isn't quite viable. But if you guys would like to see more of it on Zoom, then let me know, and we'll see what we can do in terms of putting some visual stuff out for the podcast as well. But really important conversation I had with Gary. He's going to be here with us next Sunday. I think I said to him at 8 p.m. So it'll be slightly earlier than this live this evening. So it'll be 8 p.m. tomorrow evening. And like I said, he is a millionaire. He's an ex-trader for Citibank, but now he creates content online, just like myself, to kind of share his expertise and spread the message ultimately. And that's the most important thing. That's what we're trying to do. We're trying to change perspectives. So if you have any questions, obviously just put these in the comments. Let's have a look and see what we've got here already. Is it allowed to use your ISAs to buy and sell stocks in a short time within a financial year? Yes, you can, but you need to be mindful that if you are so if you're in trading 212 and you're buying the stocks and then you're selling them, that's completely fine as long as you're not taking the money out of your ISA account. You're allowed to do that. That's no issue at all. But yeah, you just do need to be mindful in terms of all the frequency. Well, it's up to you what you do with the frequency, really. But just don't take the money out of the ISA wrapper somewhere else, because then you run the risk of breaking the ISA rules, essentially. Esther, I'm good. Thank you for asking. Yes, Kevin, the Ronaldo news is fantastic. I had a massive grin on my face. I know a few City fans, and it's funny how this tends to work, right? They were so happy and so I would say coy, the fact that they were going to get to sign one of United's legends, one of our legends, and it was all good up until he didn't sign, and then they're like, "Well, United got played." Well, I'm not being funny, but the rumor is that they are absolutely furious at George Mendes. So really, who got played? You know, it's so bizarre, but it's football for you. Look, at the end of the day, we've got Ronaldo back at Old Trafford. It's going to be an interesting season. Are we going to win trophies? I don't know. I think he will be an influence on the dressing room, which is always good for people like Mason Greenwood, Rashford, and some of the young players. I think he will definitely up the levels, definitely, and he will make us contenders. That doesn't mean that we are going to win, but we will be pushing for something. And if we do win, fantastic. If we don't, hey, it is what it is at the end of the day. But yeah, City fans can taste those sweet, sweet tears of bitterness. The fact that he didn't sign for them. I trust me, I saw so much of it all that Thursday. Oh my god! But I'm like most City United fans at the moment. I'm quite satisfied with the outcome, and I'm sure many United fans who may be watching this or will watch this afterwards will feel exactly the same as I do. Like, go get your own legends. You know, don't try and poach others. Let's see what we've got here. Esther, any thoughts on Cardano and Tezos? You know what? I've not actually followed the crypto for a while. I've been really, really busy over the last 3 weeks, which is why, literally, I know that I've kind of I feel guilty almost for like not posting as much as I have been um, on YouTube and certainly on Instagram. I mean, Instagram is I'm not posting on Instagram because of the issues of people just being able to clone the account so easily and obviously trying to scam people out of money. That's the main reason why I've not been posting as much on Instagram. But I've got so many projects on the go at the moment. Um, I spoke about a short film for the channel maybe 2 months ago. I've had to reshoot that. We just reshot it this last week, and we've got it to a standard that I'm really, really, really happy with. Um, it was intended for this channel. However, we may have a look and see if we can place it in mainstream media first, um, because the work that went into it was really, really, really good. So you may see it on mainstream media. If not, you'll see it here on the channel. But yeah, I haven't really followed anything around crypto. I had a look at my crypto holdings. It's up because I know that Bitcoin had a run, Cardano had a run, Ethereum had a run, almost everything had a run. But I've not paid any attention to it over the last 3 weeks. So I can't give you a really nuanced answer to that, Esther, right now. Sorry. However, there is a guy on here. I don't know whether Radik's still here or not. Radik's on here. He could probably give you a really good answer. And maybe Radik, if you are on, mate, I am monitoring the comment section. If you're on and you want to pop on and we can talk crypto for a bit, I'll post the link. So let me know if you're still on and we can have a little conversation. Hopefully that will benefit other people that are on here as well. So yeah, let's have a look. Yeah, actually, Ralik has just said here that okay, cool. He is on here. So let me just grab that link for you, mate. 1 second. Has that just copied? Yes, it has. Right. Okay. So right, that's the link right there, Alec. So if you want to come on, then yeah, we can talk about crypto and how you're finding things at the minute because I know that you're kind of like in the forefront at the face of it constantly because you're a popular investor with eToro. So he has people actually copy trading him. So he'll be able to give a better view than I can because I've not really paid that much attention to it over the last 2-3 weeks. So when you're ready, mate, just pop in and we can chop it up and have a little conversation and stuff. Right, so here we are. Right, this is a question in regards to Invest Engine. Sorry Pete, for asking. If I invest, say, £100 in Invest Engine per month in, say, 5 ETFs, what method does one use to know what percentage to allocate to each ETF value-wise? Only thing that stumped me. Okay. Right. Okay. So within Invest Engine, what you can do is you can build your portfolio and you can allocate a certain proportion of your money to each of the ETFs that you select. So if you select 5, your default setting will be 20% each. Now, it's this will be a very long-winded answer, but essentially you have to understand portfolio construction and you need to understand risk management. So in the video, what I did intentionally there was pick gold because gold, and you need to understand asset classes and different asset classes and what their risk tolerances are. So things like gold, commodities, those kind of things, they're almost regarded as a safe haven. That doesn't mean that they won't go down. They will, but they're regarded as a safe haven, i.e., they are less volatile than things like equities, which will be your pure ETFs like the S&P 500 or the Russell 2000, which I chose within that portfolio. Really, the first thing you need to know is what your risk profile looks like. Okay, so if you are, and typically when I do coaching, I take people through what their risk profile is so they understand where their starting position is. So if you're a balanced investor, for example, then you may say that actually, you know what, I'm going to choose a couple of ETFs that will be either, kind of well diversified from a global point of view. So you might have a look at an all cap or a global ETF. Then you might niche down into either, having something like the S&P 500 or the Russell 2000 or the small cap here in the UK. It's a really, really, it's hard for me to explain this without drawing graphs and everything. But basically, the main thing you need to try and do is try to make sure that first thing is you research where each of the ETFs and what they're designed to do. So, is it a global ETF? Is it a UK ETF? Is it a US ETF? Where is it invested? What is it designed to do? What is its purpose? Then in your own head, you need to rank and think to yourself, right, so what does that mean in terms of risk? So if you're going for a small cap, small caps are going to be way more volatile than some of the large cap companies like the S&P 500. So small cap, way more volatility. So that potentially means bigger loss, higher reward. So you then need to ask yourself, are you comfortable with having, say, 40% in that kind of ETF? If the answer to that is no, and you still like the idea of holding that, then what you would then need to do is allocate maybe a small amount, 10%, 5%, 15%, whatever you feel comfortable with within that particular ETF. Then try to search for other ETFs that will give you more of a global exposure across different jurisdictions and different regions across the world and across different sectors within the ETF as well. So that is making sure that you're not just purely invested in the UK, purely not invested in the US or Germany. Make sure you get a global fund that will be invested in tech, finance, construction, health, banking, all kinds of sectors. It's really important that you do your research on what you're investing, which is why I said to you guys in that video, make sure that you go and check out the fund fact sheet and the key information document. You have to go and read that. It can sound like gobbledygook. If you understand it, then what I've just said will make complete sense. If it doesn't make any sense to you, then I would suggest that you need coaching, which is what I can help with to help you understand where you essentially are. I know that's very, 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 very long-winded, but really at the crux of it, you need to understand portfolio construction, risk management, and you also need to understand how it ties into how long you're investing for. Because even if you're a balanced investor, for example, so let's just say out of all of the ETFs are ranked out of 7. So let's just say you're a 3 or a 4. That's what you think you are. You can and you should bear in mind that if you're looking to invest for a longer period of time, so i.e. 10, 15 years, you could probably afford to move up the scale from a 3 to a 4 or from a 4 to a 5 if you are a 4. But if you're investing for a short period of time, then it means that really, if you're a 4, you should probably come back to a 3. If you're a 3, you should probably come back to a 2. Those are just fundamental concepts that are very, very important. Long-winded answer, Ian. Sorry, but that's the best way that I could kind of put it across, and hopefully that helps. If it doesn't, then just let me know. Kevin here is just saying, follow that, Gary. Yeah, I mean, what he has to say is very, very eye-opening. I think he comes at it from a very different point of view because as a trader, his job is to basically make bets and assumptions on the outcome of what's going to happen in the economy, and you make money off that as a trader. So not only has he got the experience and he knows how to look for the macro details within the economy, what he's essentially doing is basically, well, what he was doing was placing bets, large amounts of money uh, with Citibank in order to make money, and that's how he's made his millions essentially. So his point of view is really, 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 really unique. And I like to be in rooms with smart people, and he's definitely a little smarter than I am. So having a conversation with him really kind of opened my eyes in terms of, actually, we talk about this wealth creation and we talk about how important financial habits are. There are levels to this, and financial habits are so important when it comes to really getting your head screwed on. We all think of things in terms of investing in stocks and shares and all that kind of stuff, which is great. That's just the beginning, though. That's where the work basically begins. And obviously, before that, you've got emergency funds and budgeting that's come before. Then you've got investing as part of the key steps to create wealth. But within that, you've got property as well. And it's so much bigger than what we talk about and sometimes what we perceive, which is really important to acknowledge as well. Ian, thanks for that super chat, mate. Really do appreciate it. Thank you. Damien, thank you for this, mate. Really do appreciate it. My background is I have worked in financial services for 16 years now. I've worked in retail banking, which is in a bank branch. I've worked in corporate banking, which is with businesses, small, medium-sized enterprises. And for the last 8 years, I've been in wealth management, where I qualified as a financial advisor. I have advised clients. I've worked on building investment portfolios. I've worked for investment houses, pension providers. So I try to use my knowledge now to create these videos on YouTube to help people. And that's my background, really. I just want to be able to amplify my voice. That's the goal for the rest of this year, and has been the goal this year, and will be the goal for next year as well. So appreciate you paying attention to the channel, mate. Thank you. Liverpool will win the title. Kev, I don't know about that, mate. I really don't know about that. I think you've got to get past City and Chelsea. I mean, you guys were lucky against Chelsea yesterday. Really, really lucky. Some will say you need luck, and you do, to win the title, but it's going to be a tight race. Let's definitely put that out there. Hope you will. If you have an investment property which is returning 10% net returns on investment, would this be better than invested in shares, or bigger returns be made in shares? There is potential to make better returns in shares. It all depends on what level of risk you're looking to take, though. If you're looking to take huge risks, then yes, you could make more money in shares. But the point here is that, we talked a little bit about asset classes when I was responding to Ian's question there. Property is an asset class. If you're looking to create wealth, it's not just about equities or properties. It's about a mixture of them all. Property does have its own advantages, clearly, because, it's bricks and mortar. It's physical asset that you can touch and you can feel, should appreciate in value over time. If it's an investment property, you've got a tenant in there that's hopefully paying down the mortgage on a full repayment mortgage. So essentially, you've got someone paying off an asset for you, which you're going to eventually own in the future, which you can then sell because it's a physical, tangible asset. Issue with property is it's a liquid, and it's not very, very tax efficient if you don't wrap it into the right kind of vehicles. So those are other considerations beyond just, can I make more money? Making money is great, but what does making more money actually entail? In this question, yes, you could make better returns than 10%, one would argue, on the stock market, but you'd have to take way more risk, put your capital at way more risk. Whereas with property, you could probably argue that you're not taking that level of risk that you would have to go to if you were to go into stocks and shares and try to shoot for more than 10%. So it's really about understanding within your goal and within your plan what you want to achieve, how much of a role is this investment property playing in that overall picture? Is it playing a large part, or is it just there for happenstance, kind of like, we'll see what happens type thing? I would argue that it's probably there for a good reason. And if it is there for a good reason, I definitely wouldn't trade that out for stocks and shares and go and take more risk, because more risk means that you could lose money. On the property, you own the asset, so it's always going to be yours. And if you've got a tenant in there, your risk is very minimal, Abdul. So key considerations within that as well. I've just got Relic that's just popped in as well. I'm going to bring him in right now. Dude, how you doing?
Hello, hello. No, I'm not doing too bad. How about yourself?
I'm not bad, mate. I'm not bad at all. How you been?
Yeah, I mean, I've essentially just got back from like a week and a half vacation. So
Where did
while
you
I was
go?
away, Turkey. So
Okay.
while I was away, so much was happening with crypto and everything. I was just like, you know what? I just I need a bit of a vacation, so I might not have all the information with
Uh-huh.
what's going on right now, but I know a little bit of what is happening at least.
So that's see, this is the thing though, right? Because like you want to go on holiday and everything like that, and people often don't realize that if you're trading and you're especially for you because you're responsible for obviously people copy trade you and everything like that. That's a huge responsibility. If you go on holiday, you've got to be thinking about that constantly all the time. It's quite something, mate. It's a really big responsibility.
Yeah, literally, like the entire time you're away, obviously I don't have any reception or any data, and then the moment I get back to like the hotel room or the place we're staying, then it's immediately connect to the Wi-Fi, check the markets, check,
Hmm.
make sure everything's not falling apart completely, and as long as everything's relatively on track, I'm sort of also like, okay, let me just let it be. But that, I suppose that's the thing with me taking a relatively long-term approach to my trades is I don't have to be sort of on everything 24/7.
Hmm.
Even though you do have to have your finger to the pulse, at least you don't have to worry constantly about what's happening. Because that's the thing is most traders, they sort of it's start at 9 o'clock, end at like 5 when the markets close, and then cool, they can go about their evening, go about their weekends. But with crypto, it's 24/7. Anything can
Yeah.
happen. You can be sleeping, and something can happen in China where they introduce a new regulation, or I don't know, a massive something, and then all of a sudden you wake up to minus 15%, and it's like,
Yeah.
well,
Yeah.
damage control time, you know.
Yeah.
So
Absolutely.
there are those struggles that come along with it, but yeah, it's about balancing. You also got to balance it. You can't just only focus on the markets all the time. So,
Yeah.
but
Definitely
I'm
not, mate. Definitely not.
back, feeling refreshed and ready to get back into it. But yeah,
When
crypto's
did
been.
when did you get back?
I got back last weekend,
Okay.
but I've had an exam to write and everything, so I've been studying for that and prepping for that. So it hasn't been like full time back on trading and everything yet. Also, obviously juggling a full time job right now as well.
And
So
and that's the IMC, right? That you're writing. Is it
it's
IMC?
the CISI.
Oh yeah, yeah, yeah. Okay, yeah, that's for the chartered, isn't it?
Yeah.
Yeah, yeah, yeah. Okay, that's nice. Really good. Okay, so what have you found since since you've been back? Because honestly, I've not paid attention for like I've had
Hmm.
so much going on. I'm like, oh my god, I should pay more attention to things because normally I get like emails through that give me updates on things like stocks and all that kind of stuff. And I know that with Ethereum 2.0, it rocketed, and it was parabolic one day. It was like it went from I think it was like 1,008 or 2,000 straight up to 4,000. I was like, wow, it's kicking off, and I immediately started to kick myself, thinking I should have put more money into Ethereum, but I didn't. I went and put money elsewhere instead. So, what have you found since you got back?
Yeah, so I mean, Ethereum is my largest crypto holding. It's probably one of the core foundational cryptos that I believe in the most for the long term.
Hmm.
But with regards to like Ethereum, obviously there's just that reaffirmation of everything that's taking place there. It's like, yes, this is a core crypto that's here to stay, and it's going to start challenging Bitcoin more and more. I'd love to see Ethereum sort of challenge, I'd say around like 60 to 80% of Bitcoin's market cap by around about the end of the year or sometime next year. If I have to be a little bit realistic about it, it would probably be, say, like optimistically 60% by the end of this year, if I'm being optimistic, and then maybe push for about 80% towards the middle to the end of next year. But otherwise, with regards to everything going on with Cardano right now, it's sort of just all their because the thing with Cardano is there's been a lot of promises and it's got a massive community around it. Um, can you hear me?
Yeah, I can hear you.
Uh,
Can you
yeah,
hear me? All
just
right.
yeah, just froze for a second.
Yep.
Thing with Cardano is there's been a lot of promises, but no actual delivery on any of those promises. And finally, we got smart contracts on Cardano. So that has been a topic going on forever. And then it has finally been rolled out and implemented, which is a huge step forward for the project as a whole. And I definitely think it's going to continue to drive the price. I've been getting a lot of questions on my own streams and on eToro with regards to Cardano. People are like, "Oh, is the Japan news going to cause it to?" Because it was also listed on, it was also listed in Japan. So they're like, "Oh, is the Japan news going to cause a massive increase in price? Are the smart contracts going to cause a massive increase in price?" And my answer to everyone is, in my opinion, it's already been factored into the price. I don't think people should be trying to react to what's just taken place and be like, okay, this is what's happened. Surely it's going to keep going up, because that's the fear of missing out. That's when you jump in and then you make a mistake because you don't know what you're doing. What I tend to tell everyone is understand what the future plan is. Like, I think the reason why this was such a big spike in the price is it was Cardano finally delivering on a promise, and them showing the community, yes, we can do this. Here it is. And then watch out now for the rest of our promises, the rest of the things we want to introduce and build into the project as a whole. So it's more about that accountability for me with Cardano, as well as where's it going, what's it going to do. But my own personal sort of forecast for Cardano is I definitely think this has enabled it to cement itself as one of the top 5 cryptos. At least for the medium to long term. Whether it can stay there and continue to deliver on those promises are 2 completely different things. But obviously, as much as you might love a project, you also have to look at it from the other side too, and not just with like hearts in your eyes. You need to also be able to criticize it too.
You've got to be critical about it as well, because I've literally, because like I said, I've not paid attention to it much in the last 3 weeks. I've just looked at the chart now, and like it's a massive jump, really, that we're seeing there. Do you think that it's going to be sustainable moving forward, though? Do you think it will remain at those highs, or do you think there is possibility that it's going to pull back a little bit?
So I kind of predicted a little bit of a pullback after the initial climb, and it did pull back to around like just under 2.5. It's just because whenever you have that type of climb in any crypto, there's normally about a 10 to 20% pullback. The reason I don't normally react too much to that, and why I don't say short it on the way down, is because you don't know how long that pullback's going to last. That pullback could last 30 minutes. In 30 minutes, it could drop, say, 20%, and then it can spike straight back up. But in the same time, that drop can, say, last a week or 2 weeks. You never really know. So what I tend to do, and I did that on eToro, is I took a lot of profit when it did reach those highs. I closed literally my entire position and then reopened it at about 40% of the initial exposure to also ensure that the copier sync for all the copiers remained intact. So I know we've chatted about a few times taking profit, but once again, it's when things happen like that, and that entire position was up 80%. It's irresponsible from my side to leave that there.
Yeah, absolutely. I would definitely agree with that. And I think maybe that's where a lot of people get confused around when should they not take any profits, because you're investing for the long term, but you're still looking at that as something that is responsible to do. And I think sometimes when you do see something go up 80%, you really do have to question, okay, am I really going to sit here and just wait until it possibly goes back down, especially because it's crypto and it's so volatile? Like, where's the floor? A lot of the time, trying to establish the support for some of these things can be really, really unpredictable to do. So I think, I would agree with you on that part. Where do you think Cardano might go towards the end of the year? Do you think it will stay around about there, find some kind of consistent price to trade at, or what do you think?
So in terms of end of the year forecasts, I base most of my forecasts on a relationship to both Bitcoin and Ethereum. So with Ethereum, I'll be like, where do I think Ethereum should be in relation to Bitcoin? And then where should, say, Cardano be in relation to Ethereum? Because obviously they're competing for the same market. And for Cardano, like, while it still does have a long way to go, and Ethereum's obviously one of the OGs, my price, I would like to see Ethereum around, like, I say $8,000 to $10,000 before the end of the year. or around about the end of the year, early next year. And Cardano, I would say probably $5 to $7. That would
Okay.
be sort of my price range. So I do think it's got a long way to go still, but that's not to say that we can't have another crypto winter. Like, yes, we're in a bull market again. Finally, after a lot of suffering over the past few months, it's finally looking up once again. But there's nothing to say that, say, when it comes November, that we won't re-enter sort of another massive correction.
Yeah.
So you always need to be mindful of that. But if everything remains constant and it goes the way I think it should, my price forecast is between $5 and $7.
Okay, that's interesting, and it's interesting as well on Ethereum, 5,000 to 8,000. You reckon?
Ethereum, I reckon 8 to 10.
8 to 10,000 for Ethereum. Wow.
Yeah. End of this year to sort of beginning of like January, February, March of next year. That's sort of my.
And where do you think Bitcoin needs to be in relation to that?
So Bitcoin sort of follows a similar wavelength. My forecast for Bitcoin, it's not as extreme as that, because I do think Ethereum will continue to make up ground in terms of market cap percentage. So for Bitcoin, it's sitting at between 80 to 100K for the end of the year. So it's not as big of a jump as, say, Ethereum, where Ethereum, I do think it still has a lot of potential to still like 2 to 3x. But Bitcoin, I don't really see it doing anything more than like a 2x before the end of the year.
So you're pretty much kind of putting almost like a 10% valuation of the Bitcoin price for Ethereum, really, is kind of how that would work out roughly. Well, just a little bit more than 10%.
Well, you have to let me just pull it up on CoinMarketCap in the meantime. So at the moment, Ethereum is sitting, let's just round it up to say like, I'll do, okay, 380.
I'm gonna find the chart right here actually. So Ethereum right now is at about 3,209 at the moment.
Yeah, so Ethereum's currently sitting at 41% of Bitcoin's market cap.
Okay. So
and then
so what's that growth number that you're putting on there then? So from where it is for 8 to 10,000, well, you're thinking it's going to, you've got another, really, it's going to double almost. Well, it will be more than doubling if you get that projection right for most people.
In terms of the actual valuation of, say, Bitcoin?
Yeah, in terms of the price right now, in terms of where you.
Oh, yes. You're
looking at for it to more than double.
I definitely think it can. I got asked the question, like, do I think the stages of these completely abnormal and ridiculous returns are over? And in terms of that, I would say for what crypto used to be, yes. You're not going to say invest $100 and make $1 million overnight like it used to be back in the day when Bitcoin first came in. But you also got to realize that it is still a very, very early market. And there's a lot that needs to take place.
We're very, very early in the adoption curve for crypto. And this seems to be the exciting phase where there is more and more buy-in, certainly from the wider kind of like public, and even with institutions and governments now looking at it. And that's the bit that excites me. Like, we talk about regulation being, problematic, and it may cause some very short-term issues. But my God, regulation gives it a massive tick in the box from regulators. And the minute you start seeing institutional money pile into this as well, mate, like, oh my God, absolutely go crazy.
And you need to also sort of take into consideration where we are now as to where we were at, say, the peak of the previous bull run. And the peak of the previous bull run, a lot of that growth and hype around it, it was sort of like artificially inflated by a lot of the derivative contracts, leveraged derivative contracts as well. Whereas now a lot of the actual foundation is spot buying, and there's not that much leverage behind it compared to where we were a few months ago. So I also think it's setting a more solid foundation where if there is another correction, we're going to start, instead of, say, seeing 30,000 as we did previously, instead we'd rather see like 40,000 or 50,000. And that's going to be the new baseline. Just because during all that panic selling, the long-term holders and institutional buyers, they weren't moving. They just continued to hold and accumulate more. I mean, if you look what happened with MicroStrategy as well, during the correction, Michael Saylor just continued buying more Bitcoin.
Which is what you do when you're investing for the long term. You don't care about the noise. You're thinking long term, so all the noise makes no difference whatsoever. You just continue
Exactly.
and take advantage of that price cost that pound cost averaging or dollar cost averaging through all the volatility and the selling and the buying that happens. You're taking advantage of all of that in the process as well.
Yeah, but Pete, what's your forecast for Bitcoin and Ethereum for the end of the year?
You know what? I don't actually have a forecast for it, purely because, like, I'm still learning, the whole Bitcoin crypto game myself. Like, my real area of expertise is in the stock market, like proper like stocks and stuff.
Mm.
So all of this is, I'm getting used to it myself, and I'm just looking at it all thinking, okay, as I learn more, I'm like, okay, cool, like this could be really, really big, which is why I'm so excited about it actually crossing over into the mainstream financial system, like the DeFi and all that kind of stuff. All of that is huge, which is why I'm really, 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 really bullish on Ethereum. It's why I was kicking myself that I didn't put more money into it just before it actually went up, because I think with Ethereum, most of those applications on the DeFi side are being built on the Ethereum on the Ethereum blockchain, aren't they? So for me, if the more that is able to be built out and introduced and people start using it, Ethereum could absolutely kill it when it comes to that long-term applications. And I'm just, where this is going to be in 10, 20 years time, God knows. It's like the internet, really, to be honest. And look at what the internet did for the world. This is just crazy.
Exactly. But if you're interested in the whole like decentralized applications and everything, I'd also recommend checking out Solana. It has done amazing things this past week as well. Its
Okay.
graph actually looks a little bit disgusting right now.
Hang on, let me just, I've got my eToro account actually open, so let me just see if I can actually
Oh
see
no,
Solana.
it's not listed. It's
Not
not
listed.
listed on eToro, unfortunately.
Where is it on? Would it be on
It's
Binance?
yes, it's on Binance.
Okay, I need to go and have a look at it on Binance.
Yeah,
I'll have a
I'm
look at
hounding
it.
eToro right now to add Solana and Polkadot. Like those are the two I'm pushing for.
Uh-huh.
I need those in my portfolio right now. I want my copiers to be exposed to it.
Good man. I'm just gonna have a look and see if there's any crypto questions in here. Bear
Yeah,
me one
I
second while I
saw.
scan these. Have you spotted one?
Yeah, there's been a little discussion going on
There's one
about
about Shiba.
XRP.
Okay.
Gosh. Well, we can do Shiba. I'm always happy to go on about Shiba.
All right, go Shiba first, and we get onto the XRP one.
Okay. Is Shiba Coin a good investment? In my own opinion, no. I don't think it's a good investment. It was created as a meme of a meme, which is always very dangerous.
Meme of Doge. Yeah.
Yeah, literally after Doge. But the thing with Shiba is because it's got such a massive community, they are actually trying to make it a legitimate project. My only issue with it is they're trying to do everything. And whenever I see a crypto project trying to do everything from like DeFi, D-apps, be a store of value, be a payment method, and just like trying to do everything that crypto is trying to do, I'm just like, no, you can't do it all. Rather look for the best project to tackle each of those problems and take it from there. But I think in terms of Shiba being a good investment, I definitely don't think so. And I think there's far better cryptos and far safer cryptos to look at instead of something like Shiba. I'm not a big fan of Shiba at all.
And that brings us to XRP, because XRP and what they're doing there. I think XRP have done okay as well during this period of time. What are your thoughts on that?
Yeah, the XRP, I'm not feeling too great about it recently, to be completely honest. It just feels like it's falling a little bit flat. And I think it's because Ripple's been so caught up in this court case. So I definitely think XRP will continue to grow, and it will most likely follow the trend of crypto. Will it do anything special? It might spike if they win the lawsuit, which it looks very promising that they will. So I would expect a slight spike in the price. But if that spike is anything more than, say, like 40 to 50%, I'm probably selling all my XRP and taking profit immediately, because there's just nothing that excites me that they're doing right now. And I think there's far better alternatives to XRP than XRP itself. So I think XRP is a good hedge into general like payments and like transfer transfer. Oh, what's the word I'm looking for?
Remittance.
Yeah, like a way to handle those types of things. Yeah. It's sort of a hedge into that industry, I see it as, but it wouldn't be my first choice. I think there's so many other things happening that are looking a little bit more promising there. So I'd say it's never a bad thing to have exposure, but I'd rather use it as a hedge than sort of the actual project I'm sort of gunning for.
I've got a question for you then, because there are a lot of people who are talking about this lawsuit, and if they win, it's going to go absolutely nuts and stuff. But I question, and this is, I'm going to bat this to you, and maybe people in the comments want to give their 2 cents as well. If it does spike, right, is that because of the hype of the news or because of its user cases? Because the user case for XRP for me has always been, right, okay, global remittance, sending money abroad, cheaper, quicker. It makes absolutely sense, especially when you look at the volume of transactions that the banks do on a daily basis, let alone yearly basis. It's huge. And that system traditionally has been built on very, very old, archaic systems. But the issue that I have with XRP is the fact that, in my eyes, or from what I've been able to garner, it's almost been under the assumption that the banks will adopt XRP as the coin to do the remittance, where we know that the banks are just looking at doing their own coin because they can control it. So in the user case scenarios, does XRP actually have legs beyond the hype of the lawsuit and all of this stuff that's happening in the short term right now? What do you think about that?
Yeah, well, that's essentially the massive debate. It's like, why, and especially with governments also creating their own digital cryptos, digital currencies, you sort of in this entire debate of like, yes, this has a lot of potential for something like XRP to work, but there's obviously this massive risk of, say, the banks doing their own thing, the governments doing their own thing, and even a more decentralized project that actually gets started, because XRP isn't as, well, Ripple and XRP, it's not as decentralized as, say, the rest of crypto. It is like far more centralized, where Ripple owns like majority of XRP. They have so much XRP that it sort of goes a little bit against crypto, but also it doesn't go against crypto at the same time. So it's one of those weird relationships where I think it's good to have skin in the game, but not too much. And that's why I say treat it as a hedge. It's, yes, I would definitely like to explore that whole industry more, but I wouldn't like that to be, say, I wouldn't like XRP to be, say, 80% of my exposure into that sector.
And I think this is where it's really important for people who are looking at crypto to really understand, what the coin, the user cases are, and actually understand those things, and not just in isolation, but in context of the wider picture as well. Because it's very, very easy to get on the hype of, if the banks pick this up, it's going to be absolutely nuts. Look at the remittance numbers and all this kind of stuff. The adoption levels will be absolutely crazy, but there are fundamental issues and questions there. And unless you understand that, you're going to put, like you're saying, 8% of your money into an XRP coin that potentially doesn't even take off. And all this time, you've then forgotten about everything else. You've forgotten about Cardano. You've forgotten about ETH. You've forgotten about Bitcoin and all these other coins that are coming up as well. And this is where the education piece becomes so important, because it isn't about the hype. It's about actually understanding what it's there to actually do, and if it actually has legs in achieving what it says it's going to do as well.
Exactly. And that's also where you need to sort of be fully up to date with the project, not only, say, specific cryptos, but cryptos around the ones that you do follow as well. Because my top picks for cryptos 3 years ago are completely different from my top picks for cryptos now. Some in my top picks 3 years ago, I wouldn't tell anyone to touch at all right now, because it's just the project's sort of fallen flat a little bit, or it's lost a bit of its like oomph. So I would say it's one of those things where you need to also with a rapidly expanding industry, you also need to rapidly review your own profile and your own exposure into the entire sector. It's constant rebalancing and keeping up to date. So, I mean, I like 3-4 years ago, I had pretty much no Bitcoin. It was like all Ethereum, and then as Bitcoin sort of become more and more of that foundational crypto, and instead of it, everyone's thinking, oh, it's going to be the way that transactions are done. It's become more. It's going to be a store of value.
Yeah, and a hedge against inflation. Yeah,
exactly. It's going to be that. It's going to be like the digital gold.
Mm-hmm.
And then I'm like, okay, now I see more of a use case. Whereas before, everyone's like, oh, Bitcoin's going to be the currency everyone uses, and I'm like, well, that doesn't really make sense with how Bitcoin works.
Yeah, yeah.
So it's constantly adapting, constantly changing. It's a fascinating industry to be a part of and watch on the day to day. And I'm constantly learning about new projects as well. And that's one thing I enjoy about the social side of it is you always have someone say, oh, what about this crypto? What about that crypto?
Yeah. Here's a question for you then. On you say you're learning about new coins and new projects all the time. What's your go-to resource for information?
So there's a few. First of all, every now and again I'll see some projects be thrown out on more of the social media platforms. So eToro, Twitter. That's often where I'll catch wind of some of the newer projects, as well as like sort of my own friendship circles. So if they're interested in crypto and they don't have a crypto community, I would highly recommend sort of joining one that might already exist, or sort of piggybacking on one that does already exist, say like on Twitter or something, just following someone involved in the space. But then in terms of day-to-day news with crypto, mostly Spotify podcasts. The CoinDesk podcast is amazing. That's the first thing I listen to every single day. And then also CoinMarketCap. That has so much information on it. And I think it's a very underestimated source of information. People just use it to sort of look at the rankings, but it's got information on each crypto, as well as links to wherever you need to find white papers and further information on that too. So there's a lot of different places people can look, but also when in doubt, just Google search. The number of times I found things just by googling, you're actually surprised. And it's like, oh, it's so obvious. Why didn't I do that first?
Yeah,
you know?
absolutely. I'd agree with that. There is a YouTube channel as well that the guy's based in London, Coin Bureau. He's really, really good. And he explains things so simply for most people to be able to grasp. That's a good as well. I watch quite a bit of what he talks about because he knows, he really does know what he's talking about as well. Cool, man. All right. So thanks for joining us for this, mate. This is a point, by the way, guys. You should go and follow Relic's YouTube. What are your socials, by the way, so people can actually follow you, because you do this on a day-to-day basis stuff. So it makes sense for people to go and follow you as well.
Yeah, I mean, I think the easiest way to find like all my socials and everything, it's to check out my link tree. So it's linktr.ee/Relic. All my links are there, but otherwise I'm trying to be a lot more active on Twitch and YouTube, as well as eToro. I would say that's where I post every single day. I'm very active on there. I answer every single question. So if anyone ever wants to reach out, have a chat, or they've got a project they want an opinion on, like just feel free to send it to me, and I always try make a point to reply to every comment.
Tell me your link tree again, sorry, mate.
It's literally linktree/Relic with two L's.
Relic. Okay.
Yeah.
So that's www. Isn't it?
Yeah.
I'm gonna find it. I'm gonna pop it in the in the comment section for people.
Wait, I can send it on the.
Yeah, you can pop it in the comments so that people can actually just go grab and follow. That'd be really, really good. And like I said, people do copy you on eToro as well. So feel free to go and do that as well. But I appreciate you coming on because yeah, you picked up the slack on the crypto question for me this evening. It's good.
No, it's always a pleasure. Like I was just chilling at home, just relaxing after quite a busy Sunday, and then I tuned in for the stream, and I thought, maybe I'll pop on for a little bit.
Yeah.
No, but it's a pleasure as always.
That's always
And
good to have you, mate.
thanks for
Always
having
good
me
to have you.
on. Thanks for
No
having me
worries, mate.
on.
Catch you in a bit. Cheers.
Cheers, man.
All right, there you go, guys. So yeah, if you haven't followed Ralik, go follow Ralik on his socials. Yeah, so let me just see if I know there were a number of other questions that came in here as well. So I'm just going to see where I was prior, and maybe tackle a few more questions on here as well. Right, where are we? What's your views on investment trusts for income? Investment trusts can be good for income. They're a good vehicle for income, obviously. Um, it depends on how you access in these investment trusts, I guess. For most people, they will use ETFs and so on and so forth to access it. Just make sure you understand the pros and cons. But there's nothing wrong with investment trusts for incomes. Let's have a look at this one as well from Damien. What are the long-term flexibilities of ISAs for changing investments, i.e. money invested in year one? Can this be moved to another provider in year 4 with interest earned and change investment strategy? Yes. So ISAs are fully flexible. The key thing here is you should not. So for example, if you've got, year one money with Moneybox, for example, and in year 4 you want to move it, don't close the account and then try and pay the money into a new provider, say, I don't know, Plum. You can't do that. Number one, because you've taken it out of the ISA wrapper. Let's just say in 4 years you've been able to, get £40,000 across those 4 years. You can't then just go put it into that account because remember, if you take it out of your ISA account, then you are going to potentially have used up all of your ISA allowance by doing so. So the best way for you to do that, if that is what you're looking to do, is to identify your new provider and ask them to transfer the money from your old provider to them. They should do that within 30 days. That's generally the timeline that they work to, 30 days. And yeah, it will just be invested in whatever investment strategy that you've chosen with your new provider. That's how I would go about it, in opposed to closing the account, taking the cash, then moving the money yourself. Get the provider to do it on your behalf, Damien. Let's have a look at this one. This is from Josh. I had my first child a month ago. Congratulations, mate. Do you have any advice for savings and investing for her future? Look, there are a couple of ways, mate. You can do things like junior ISAs. Junior ISAs are great. You've got a £9,000 allowance for that each year. So you could pay into the ISA. You could have grandparents or great grandparents. You could have aunts, uncles, cousins. Any member of family can pay into that account for your child's future. Just be mindful, though, that with junior ISAs, it will be in the child's name. So at some point in the future, 16 is where really they have the ability to take hold of that money. So there are a couple of key things that are very important. If you're going to do a junior ISA, make sure that you're having the conversation with her around, or him or her, about money management, so on and so forth, and try to maybe position it so that they use the money responsibly. I have seen it be a nightmare for people having accumulated quite a bit of money for their kids, only for them to take hold of it in their teens, and they're worried about what they're going to spend the money on. But junior ISAs are a great way. You could also, if you wanted to, pay into a pension as well. You've got junior pensions which you can pay into. Obviously, the access to that isn't until much later. So again, it's 55 under current rules, but it could be a really, really good avenue. For most people, if they're looking at maybe accumulating a house deposit for their kids, junior ISAs are great because you can access it, or it will be available fairly early. So, and you get to be able to control it up until when your child inherits or takes ownership of it when they come of legal age. So, mate, congratulations! Exciting times. But yeah, a junior ISA may be a really good place for you to start. Let's have a look at this one from Olat. I'm in my early 40s, looking to retire at 60. Currently have 1,200 to invest every month. Eureka or Vanguard? I'm in full-time employment, so I have a workplace pension going on the side. Okay, so Eureka or Vanguard? Vanguard are really good in terms of, well, so let's have a look at the practicalities of Vanguard and Eureka. So Eureka, what we will do is we will essentially ask you how much you have to invest. Is there a lump sum? Is there a monthly payment? And how long you're looking to invest for. So for you, 20 years, we will select a portfolio on your behalf. We will have a look at all of the risk management, all of that as part of the setup for you. With Vanguard, actually, let me finish this on Eureka. We'll charge you £500 per month. Your first £500 is free. So yearly, it's going to cost you £60 per month. With Vanguard, you're going to have to understand what options you're going to go for. So I just had a coaching client where we concluded this morning a retirement package or plan for him. And we talked through all of the life strategy funds. We talked through all of the target retirement funds because they do have those available in Vanguard. You have to understand what you're looking at. So, for example, for him, going through the life strategy funds, going through the target retirement funds, talking about going through his attitude to risk. So, where is his risk profile? So, again, within Vanguard, they score out of 7. If you're a 4 or a 3, which of the options in the life strategy or target retirement are appropriate for you? With 20 years, can you afford to go up higher? Like I mentioned earlier when answering the question for Ian. So we went through all of those considerations. You have to understand that if you use Vanguard. If you go with Eureka, we're going to do all of that in the background for you. For Vanguard, you're going to have to know that. You would also have to understand what the charging structure is for each of the options within Vanguard. So, for example, the life strategy are charged at one point, at one price point, and the target retirement funds are also charged at one price point. If you then decide, well, actually, you don't want either the life strategy or the target retirement funds within Vanguard, you also have access to all the other ETFs and all the other index funds. Again, you kind of have to understand what you're doing. That's what I try to help people understand when I do coaching. So, for example, if you came to me for coaching and you wanted to go with Vanguard because that's your preference, then what we would do is we will go through a risk questionnaire. We'll try to understand what your goals are. We need to actually work out what income you're going to need when you get to 60. That's a crucial point. So that can be a hard thing to gauge. What we try to do is have a look at your expenditure now and factor out a few things. Try and see, right, what would your workplace pension be worth roughly? What state pension are you going to have? Then we try and work out how much you're going to need in terms of a pension pot or an investment pot to be able to fill the gap in your income. I would go through all of that stuff with you in coaching. And I would also go through, right, if it is Vanguard, right, let's talk through your attitude to risk, how long you're looking to invest for, what level of risk you're happy to take, unable to take, and then filter down, is life strategy okay for you? Are retirement the ones that you should be going for? Or do you want to go for one of the other index funds or ETFs within that selection? And helping you understand what all of that means within Vanguard. So it's a long-winded answer. You can go for either Eureka or Vanguard, but like I say, they do two different things. So Eureka's fairly simple in terms of helping you make the decision in terms of the thought process. With Vanguard, you need a little bit more. You can obviously do it yourself if you understand what you're looking at, but if you don't, then consider reaching out to me on either Instagram or well, Instagram is going to be the best way really, or maybe on Twitter, and then we can talk through coaching possibly that might actually help you. So that's a long answer, Olat, but those are some key things for you to consider. All right. I'm just trying to find. I'm way up in the chat, by the way, guys. There's quite a bit that I need to catch up on. Gary is, I think he's in his 30s. He's in his early 30s. I think he's 32. let's have a look at this one here. Hello, Pete. Have you invested in REITs? Are they a good strategy for dividend income? I don't invest in REITs. I don't have anything in REITs at all. REITs are purely just property, normally commercial property. For me, it's too much of a concentration in the property aspect or using that asset class. It's too concentrated for me. So I don't have any in REIT at this point in time. Um, you don't get a dividend from REITs. It's rental income, so it's still classed as income. It's not a dividend in the same way. So dividend is essentially buying shares in Coca-Cola. They pay a dividend, which is a share of their profits. That's a dividend. With REITs, it's something different. So I haven't invested in REITs personally myself. That doesn't mean that you shouldn't. If you want exposure to commercial property, then commercial property and other kind of properties as well, then it could be a really, really, really good route for you to go down. But you do need to understand how REITs work. Yeah, there are different ways you can access them. I've had some horror stories about REITs specifically, which is why I prefer not to, in the traditional sense. But that doesn't mean that you shouldn't. Just make sure that you understand how REITs work and you look at all the pros and cons. Um, Cheers for this, Otis. I appreciate that. Thank you very much. Just want to say thank you so much for such good content. Wish I knew about investing and handle my finances better at an early age. Look, me too, which is why I do this, just to kind of help people. Um, I haven't been following this. I need to have a look at this. I haven't followed that. That's the first I've heard of it. So the last 3 weeks have been really, really busy with a few projects. Let's go all the way down here. Ah, interesting. Anyone who's used MasterCard between 1992 and 2008 could get £200 if the case is successful. That would be a class action suit then, really. Let's have a look at this. Following for Nitora since eventually copied the portfolio because I really like your strategy. There you go. Good man. Good to see you on here as well, Andy. Thanks for joining. Right, let's have a look and see what else we've got. I've just hit the conversation about XRP and Shiba. So I'm just going to scoot past this and see if there's anything further down that we can get stuck into as well. There's quite a bit of conversation there about the crypto. And cheers for that super chat, Reddit. Thank you so much. Really do appreciate it. Guys, actually, let me just make sure I do this. If you are finding this valuable, there's 52 at the minute. Let's make sure that we smash the like button, please. That will really help me out with the YouTube algorithm. Yeah, so don't forget to do that, please. Let's have a look. This is a good question. How do you know if a person's investment platform is a scam? How can you tell? Have you heard of Promax? I've not heard of Promax. Who are Promax? Let's have a look. The only Promax that I've got on Google search is Promax syringe. It's all veterinarian type things. Let me just put Promax invest. Maybe that might bring something up. Promax investment, Abu Dhabi. Red flag right there. So it's in Abu Dhabi. So just be careful straight off the back. Promax Invest Limited overview. There is a UK business, but I cannot see any websites for it. There is Promax Investment LLC.com, which is American because LLC is American. And this is all about oil and gas, cloud computing services, wholesale trading, training centers, laboratory. If you've got a link to this, maybe send it to me and I can have a look. But I mean, look, if it's a company that is in the UK, I say this all the time: FCA registration. They have to be authorized and regulated by the FCA. They should offer you compensation on the Financial Services Compensation Scheme. You can use the FCA register to just literally search a company's name. If they are registered with them truly, then you'll see it on the website immediately. I think that's really important in terms of due diligence. If you can't find any reliable information, then you do need to be very, very careful. You really, really do. The reality is that there are a lot of people out there at the moment who are spamming people on Instagram, that are essentially just emailing people, texting people if you've got your number on public domains. I had one earlier today actually. Someone asked if I wanted to do a business collaboration for a cloud trading service or something like that. I told them to piss off in the end, because they were like, "Oh, as long as your wallet has credit, you're guaranteed a 5% per day." That kind of language should send off alarm bells immediately. There is no way on earth that you're going to get a 5% per day guaranteed. Like, just do the maths. 5% per day times 365 is 1,825% return. And we haven't even compounded that. It's absolutely and utterly ridiculous. So please keep your eyes in the back of your head and keep your eyes open. Like I said, there are people on Instagram right now pretending to be me, trying to scam people. It's one of the reasons why I've not done as much on Instagram, and I've kind of stepped back, because I just don't want to be held, someone to point their finger at me saying, "Oh, we sent you money." I've had a few people say that already, who have fallen for these scams. "Oh, we sent you money. We thought you were a good guy. You've scammed me out of, like, one person sent 2 grand." And I was like, I would never ask you to send 2 grand anywhere. I wouldn't ask you to do that. Yes, I'm involved with Eureka. We are authorized and regulated by the Financial Conduct Authority, and we do offer financial services compensation scheme if our business went bust. We don't offer you trading services. We don't sell you a dream. We don't, you know, promise the earth. We're very, very clear about how we work and the risk of investing and all that kind of stuff. We're still a startup, you know, but we're very, very clear in our intentions and what we plan to do and what we're trying to do. We're not trying to promise 5% returns and promising to make people rich. That's not what it's about. And if people are telling you that, you need to run for the hills. You really, 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 really do. So please, 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 please be careful. Um, and if you can't find information easily, then just swerve at all costs. Really, really do. Andy, thanks for that super chat as well, mate. Really do appreciate it. Thank you so much. I know. So I know that you had Vanguard has now sold all the holdings, and I think the transfer will happen anytime soon. Perfect. That's fantastic to know, mate. Thank you for that. Yeah, there was a little bit weird in terms of their process, because they shouldn't have taken that long, but I guess they are Vanguard. So, and to be honest, a lot of these companies will often take a little bit longer, so they hold on to your cash a little bit longer sometimes. They're notorious for doing that. Not Vanguard specifically, but the industry is notorious for doing that when it comes to things like pensions as well, because they can. So yeah, cheers for that, and thanks for the super chat as well. So many scams, so many good platforms. Why not go to the good platforms and prevent getting scammed? I think a lot of the time, mate, it's all about it's not necessarily about common sense, but I think it's sometimes because people do want their money to go a little bit further, and because we've had 18 months of people making a load of money on crypto and making a load of money on Tesla and Amazon. It feels as though that is the normal investment landscape, and it's not. It's not. It's very, very unusual for shares to increase 100% overnight, or for you to be, looking at returns on Amazon of 300%, Tesla 600%, or whatever it was. These are very, very unusual times. But unfortunately, because we've had that on quite a number of occasions over the last 18 months, people feel that that's normal. People feel as though they need to be chasing those high returns. So, you know, if someone's offering 5% per day, it sounds realistic when actually it's not. And people will say, well, if you're a good trader, you can achieve that. No, you can't. Like, the top traders in the world don't get 5% consistently a day. Like, they'll be lucky if they get 1% consistently a day. They don't even do that. Like, the top traders in the world have annual targets, and if they do 20%, they've absolutely killed it. And the reason why they've killed it is because these boys are playing with large sums of money. If you've listened to the podcast with Gary and you watched the episode, he was talking about the guy who was on Instagram talking about how he made £500 over 10 trades. So he made 5 grand, and he was saying, I do this all the time, it's easy. And Gary goes on to explain that the reason why he's making £500 per trade and 5 grand on 10 trades is because he's looking for the tiniest move in gold, but the actual lot size, what he was trading, was worth £600,000 per trade, leveraged, more likely, because it's very unlikely that he would have 600 grand in an account. So he would have leveraged £600,000, which means, yeah, he's made 5 grand, but if that trade went the opposite way, he would have been bankrupt. And this is the nonsense that people are saying on Instagram and have been seeing over the last 18 months, 24 months, 36 months, where people feel as though trading is just so easy, so simple, but they're not showing the risk. And I'm really looking forward to the stream with Gary next week, because he is a trader. And it isn't included in the podcast, but beforehand we were talking about day trading, and he thinks it's a fool's game. And he is a professional trader. He goes, I wouldn't even day trade my own money. I wouldn't even do that with my own money. On occasions where he does, he goes, my intel is solid. So he's trained, he is qualified, he has shed loads of experience. He was Citibank's most profitable trader in 2011 globally, out of 250 traders. Just think about that. He would have made millions that year. That's why he's a millionaire, and he would not day trade. I'm looking forward to the conversation with him next Sunday, because he will drop a load of gems, and there'll be things that people won't want to hear, which is fine. But my channel is all about, speaking truth where it needs to be spoken, and sharing knowledge and wisdom that isn't just, fantasy and fallacy, is actually lived experience. And Gary has a lot of lived experience when it comes to, trading specifically. So, yeah, I mean, people should go to just normal platforms, but unfortunately they don't a lot of the time, because people are just promising things that, even though they're too good to be true, seem realistic for many people. How long does it take to transfer from one ISA fund to another, and why so long? I have both funds with Vanguard. Right. So the general rule of thumb is it shouldn't take more than 30 days for an ISA to be transferred. If it takes more than 30 days, then essentially you have possible ground to actually ask for compensation, particularly if you've lost money in the markets. So 30 days is what they give them to do. If they're taking longer than that, then you really should be on them. You should be phoning them and saying, listen, you're taking longer than 30 days. I want to know why. What is the reason for it? If I've lost money, will you give me any compensation? That will probably put a little bit of a boot up their bums. But it should take 30 days. It shouldn't take any longer than that, unless there are, other circumstances. But if it's Vanguard, they are a big company. They should not be short staffed. They shouldn't have any issues or anything like that. 30 days is the guideline. What do you think of the Vanguard US Equity Index Fund? It is concentrated in the US. So, the US is a good market, though. It's a really, really good market. It will be diversified across sectors. It's a good bet, but you have to make sure that it fits within your risk profile, and it fits within your appetite in terms of where you want to invest, and it fits into your plan. If you're betting against the US market, people would argue that maybe that's not a good bet to make. But I would still say that you should have global exposure in your overall portfolio. I mean, obviously, I've got the S&P 500, which is, for me, doing quite well. I think I'm up like 4% or so at this point in time. But that's only a small part of my overall portfolio. I've got a load of other global index and equity fund, index and ETFs within my portfolio. So, US is good. US is very, very good, biggest economy in the world, but you need to think about it on the wider scale, not just on its own. What is it doing within your portfolio? What role is it playing within your portfolio? And how does that relate to your wider goal? Hey Pete, I've got a SIP and also an ISA, but also want to buy some shares on stake. Wearing the stake hoodie right now. Happy to let them grow for 7 to 8 years and wondered if you would recommend 4 to 5 companies to buy. Martin, that's really, really difficult for me to do because if you go and buy 4 companies that I recommend right now and they all go and dive tomorrow, that will be my fault for recommending them to you. I will give you some thoughts to start off with, though. So, if you're looking at buying companies, think about size. Okay. So, 7 to 8 years is not long term, that's medium term. Yeah. Long term is 10, 15, 20 years. So, you're talking medium term. So, with that being in mind, when we look at investment timeline theory, medium term means that you should be taking as small a risk as possible. Some people will argue buying individual stocks on stake is way up on the risk scale and you shouldn't be doing it. But if you must, and that's what you want to do, start thinking about some of the large cap companies, because they're the ones that are likely going to be there for many years to come. They will have good foundations in terms of they'll have a lot of financial strength, right? So I'm going to give this example with trepidation. Coca-Cola, right? Massive company. They sell millions and millions and millions of bottles and servings of Coca-Cola every single day. They are a dividend paying company. Coca-Cola isn't going to go anywhere unless their market completely dries up. They've got a lot of cash. They're profitable. They're profitable because they're paying dividends. So again, if you're looking at large cap, big established companies, if they're paying dividends, that tells you that they're profitable. A company cannot pay dividends if they're not profitable. So if a company is paying dividends, fantastic. That tells you that they've been around for a while. They're big. They're making profits. They should have financial strength. So think along those lines, because 7 to 8 years is medium term. It's not long term. You cannot afford to be buying high risk companies, i.e., startups, new IPOs on stake, unless you are completely happy to lose all of that money. So, depending on what your risk appetite is, and I'm going on what investment theory tells us. If you're looking at investing for the medium term, you should be taking less risk because you haven't got enough time for the stock to fall and potentially recover. Remember, market recoveries take anywhere between 5 to 10 years. So you're investing for 7 years, 8 years. If the market crashes day one of you buying into that stock, it could take 5 years for it to get back to where it was. So therefore, you don't want to be looking at risky companies. You need to be very, very selective and make sure that you're looking at some of the large cap companies. Those companies will still carry their risk because their stock could still crash, but it's less likely that their stock will crash as severely as maybe some new companies or companies that are less established in terms of their history and financial strength. So I've not given you, 4 to 5 companies to buy because that would just be irresponsible of me because I don't know your circumstances. But what I have done there is giving you some food for thought, and that hopefully gives you a ground to do some research, some further research. Again, if this is the kind of stuff that you need, hand holding, I do one-on-one coaching. We can talk about this, and we'll talk about your longer term goals. Go through a risk questionnaire with you and start to really think about, okay, is that really the right route for you to go down? I can show you research tools. I can talk you through picking stocks and how you do that research properly. I can do that in coaching. So just think about it. But I've given you a few things there that you can use to do some further research. So look at this. US equity fund and it's given 10% return over 3 years. Okay. For the US, that seems a little low for the US, to be honest. I'd be interested to see what it's invested in, what the holdings are within it. Really, to be honest, because yeah, you look at different parts, because the US market has different parts to it. Obviously, you've got the S&P 500 and some of the large. See, all markets have got large cap, mid cap, small cap. So where is it? Where are the companies that equity fund is invested in? Is it predominantly in a particular sector, or is it broadly across the whole thing? It'll be interesting to know. But that over 3 years, over 10% over 3 years seems a little bit low for the US economy. Let's have a look at this. There are no such things as stupid questions, MC. After the end of the year, one ISA, what is best? Leave the 20K in with the profits gained, use GI account to continue investing, or remove the 20K and start again? No. Okay. That's actually a very good question, not a stupid question. So if you use your £20,000 allowance in your ISA in year one, and let's just say you want to continue investing, but it's not the end of the tax year yet, you're right. Use a general investment account. And then when the new tax year kicks in, simply move money from your general investment account into either the same ISA that you had in year one, or a new one, or you could don't remove the 20K. Like, take it out in cash. Don't do that. That's the worst thing. You don't want to do that, because you won't be able to pay that back in to an ISA and continue to contribute for the existing tax year. So don't do that. Once you've filled up your 20K ISA, continue to invest in a general investment account, a GI account, as you mentioned there. Then when the new tax year starts, you can transfer from your general investment account into your new ISA for the new tax year. If you wanted to, you can then transfer that from where it was in year one to another provider. But make sure you do a transfer and just don't take the cash out, because the maths won't work. All right. So again, your allowance for ISAs is £20,000 per year. If you maxed it out in year one and you close the account to take it somewhere else, well, you've lost your allowance from the previous year because you've taken that cash out. You can only then pay in £20,000 in that new tax year. Any new money that you had sat in your GI account will not be able to go into that ISA that you just opened, because you've already reached the maximum that you can contribute in that new tax year, being £20,000. I hope that makes sense. Pete, if I do an accountancy degree, do you think I'll be able to beat the market? No, you won't. An accountancy degree won't help you beat the market, mate. Definitely not. People who have got chartered qualifications in investment management and securities sometimes can't beat the market. So an accountancy degree definitely won't help you beat the market. If you're talking about the stock market, that is, which I assume you are. I'm just scanning questions, guys. I'm really conscious of time because this is about an hour and a half. And I still have a pod to edit for tomorrow. All right, this is a good question. Is a 100% equity portfolio safe for long term, built around regional ETFs like the S&P 500, FTSE 250, FTSE 100, VERX, European excluding UK, Japan? Well, when you say safe, what do you mean by safe? Safe is relative. Like, no investment portfolio is safe. If the S&P 500 takes a dive, your S&P 500 ETF is taking a dive. Same with the FTSE 250, the FTSE 100. If all of those markets take a dive, your investment portfolio is taking a dive. There is no such thing as safe. If we want to start talking risk management here, you've got it all in equities. It's a 100% equity portfolio. You have not used any other asset class. Well, you've got a REIT in there, so you've used a little bit of property, but you've got no bonds. Number one, you haven't got any commodities, any gold or anything like that. You've got no hedge whatsoever. So you're not going to be safe. The benefit that you have is if you're investing for the long term, and again, it depends on what your definition of long term is. 7 years, 8 years, 5 years is not long term. 10, 15, 20 years is long term. If you've invested for that length of time, then you could say it's safer than it would be if you were only investing for a 5 to 10-year period, because you've got the ability to actually ride out the market volatility over that long term. But are you safe? You're not going to be 100% safe, But within that, you've used REITs, which is property, commercial property, as a little bit of a hedge. I would argue, and I don't know what your portfolio mix is, how much is actually within a REIT, but one could criticize and argue and say, well, actually, that you maybe need a few bonds and stuff like that to help you offset. But it's hard to say without seeing it. But 100% equity portfolios always going to carry risk, mate. Always going to carry risk. All right. Okay. Cool. Martin, thanks for that response, mate. Hopefully, it was helpful and stuff. Right. There are two questions in here that I'm going to answer. Then I'm going to call it a day. So there's this one: what to do with a lump sum of money to beat inflation and have access to cash? This is a very, 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 very difficult question to answer. Inflation, I can't remember what the actual UK inflation numbers are right now. Let me see if I can just find this 1 second. Bank rate tries to keep it at 2%. I think we're a little bit higher than that at the moment. I think we're at 2.5% or something like that. So the reason why that is important is because sorry, bear me 1 second. I'm just trying to find what the existing rate is. I can't find it. The reason why that's important is because in order for you to beat inflation, you need to actually get an interest rate or a return over the rate of inflation. So if the Bank of England base rate, well, the Bank of England target is 2%, means that you have to get an investment return or an interest rate of 2% in order to beat it. Well, to match it, that is. Then 2.5%, 3% will beat it. That's very, very hard to do now with interest rates so low. So savings accounts are completely out of the question. So the only other place that you could go will be to go into investment opportunities. Investment opportunities mean that essentially you're going to lose access to the cash and you've got to take on investment risk. You could argue that maybe NSNI premium bonds, but I think they're only offering 1% right now, so you're not going to beat inflation. However, you could potentially win like their draws, because they do weekly draws. You could win up to £1 million. You might get 25 quid, 50 quid there. So you may or may not meet inflation there, but you will have access to the cash because you could literally just close that account down at any given time. The only other options that you do have is you could have a look at, fixed rate accounts, but again, you're going to have to tie that up for a year or two, which will lose you access to the cash. So at this point in time, Vernon, you can't, mate. You cannot beat inflation and have access to the cash at the same time. You have to sacrifice. If you're in a position where you do have a lump sum, what I would probably be saying in coaching is this: how much have you got? How much can you allocate towards beating inflation? Then hold a little bit of money back for cash, just as an emergency. That's what I'd be exploring with you if we were doing coaching, because unfortunately at this point in time you can't have your cake and eat it. You can't have both things at the same time. So it means that you've got to compromise. You've got to have a bit of a strategy around how you split it. So maybe look at, I don't know, some investing or something like that for a little portion of the money, but hold some money back in cash should you need it. But again, with investing, you've got to take on investment risk. So yeah, if I was a shyster, I'll be telling you, mate, yeah, go and put it into this and get you 5% per day. I will be lying to you. And if anybody is telling you that on social media, they are lying to you. So please be careful. All right. So do you think bonds are still likely to rally despite their historical low yields in the event of a stock market crash? Good question. Quite possibly. But again, there are a number of factors that impact bond yields. So unless those highline factors are addressed, then it's one of those situations where it's difficult to say. Look, I get asked this question all the time about, is it worthwhile putting money in bonds? The returns aren't that great, so why should I even bother? I'm just going to go put it all in equities. I cover this in my course, and I've covered this in a number of videos. You have to remember what a bond is there to do. Okay, and there are different types of bonds. There are government bonds, there are corporate bonds, you call them treasury bonds, whatever you want to call them, but typically there are mainly two, right? And bonds are an IOU, which means that essentially they carry less risk than equities. If you're a risk averse person and you're investing money into the stock market, or you're building yourself a portfolio, yes, the return is important, but it shouldn't stump the purpose of what a bond is. A bond is there for a little bit of stability in your portfolio. So if the stock market crashes, typically bond prices will typically go up because people look for other alternatives. That's how things typically work. But as you can probably are aware, the last 3 years have not been typical by any measure of the imagination. So it's really, really hard. But if you are looking to build a portfolio, you have to do your research. You have to do your research. There are a lot of factors that impact bond yields. And unless those factors start to change, it's very hard to do. But in terms of, portfolio construction, and the role of a bond is there to give you a little bit of a hedge, so that, you may only get, 1 or 2% yield. But if your investment goal is, I need to make 7% per year, and you're getting 1 or 2% from a bond, then it means that you can afford to take less risk in your equity by only seeking 5%. That's the whole point. It's there as part of an overall strategy to help you achieve a particular goal, an investment goal. So you got to remember what the role of a bond is and how that fits into your overall plan. But yeah, I hope that helps. All right, guys, we've been on here for an hour and a half. I appreciate all of you on a Sunday evening. I've got a podcast episode to edit. But guys, yes, Gary will be here with me next Sunday, 8 p.m. I'm really looking forward to having the conversation. He will obviously take some questions from you guys as well. I'm really looking forward to it. He's a really good guy, really down-to-earth guy. And yeah, hope to be doing a little bit more with him as well. We need to organize maybe a shoot for some videos in London. Sorry, the picture quality is a little bit low on the stream. I'm looking at it on the other side of my screen right here. With the camera that I've got right now, if I shoot HD, it constricts the view. This is standard quality. And if I wanted to go HD, this is what it basically does. I'm not sure whether it's a setting within Restream, which is the program that I'm using right now, or whether it's a setting in the camera. It works fine everywhere else apart from Restream. So as you can probably see in a minute, there you go. There's a little bit of a delay between me speaking and actually coming through on the actual stream. The quality is a lot better. So that's why you're seeing a constricted screen a lot of the time when I'm doing lives now. But I appreciate you guys for tuning in. I could really do with some feedback from you guys in the comment section around some kind of content that you want to see. I do have a ton of ideas for content streams moving forward. It will be a departure from a lot of the stuff that has come on the channel beforehand. I'm a little bit nervous about producing that kind of content because I don't know how it's going to be received. It will still be finance related, but in a completely different format. And it's going to cost me money to actually produce in terms of production team, studio, and a lot of other stuff. I literally have just finished shooting a short film, which is going to be pretty epic, but it's taken a lot of time and financial effort to actually be able to produce. So, feedback in the comment and the community section around content that you would like to see would be really, really great. But I appreciate you guys. Have an amazing, it's bank holiday. Have an amazing bank holiday tomorrow. And yeah, I'll see you on a video on Tuesday next week. All right, guys, catch you soon.